As of 12:15 p.m. Eastern Time on Wednesday, January 7, 2026, Plug Power is currently trading at $2.25, marking a sharp intraday decline of 6.05% after opening the session at $2.41. While a 6% drop in a single morning might seem like a standard Tuesday for the clean energy sector, the timing of this move creates a fascinating tension between what the market expects and what the underlying data is actually suggesting. Most retail investors looking at their Robinhood app today see a stock that is struggling to hold on to the $2 level, yet institutional activity tells a much more nuanced story. The expectation among the casual crowd is that Plug Power is caught in a death spiral of dilution and cash burn, a narrative that has followed the company for years. However, the reality of the last 48 hours is that Plug Power just executed a strategic maneuver with Walmart that fundamentally changes the dilution math for the next few years. They've managed to eliminate the potential for 55 million shares of warrant dilution, a move that provides a massive relief valve for the cap table, even if the intraday price action hasn't fully digested the long-term implications yet. This gap between perception and reality is where the real opportunities often hide in the stock market. If you were sitting there with a cup of coffee wondering why a company with massive partnerships like Amazon and Walmart is trading like a penny stock, you have to look at the mechanics of how this business is currently being funded. For anyone using Interactive Brokers or the Fidelity mobile app, the high volume and short interest in Plug Power make it one of the most volatile names in the energy space. The tension here is simple. Investors expect a clear path to profitability that mirrors a traditional tech company, but the reality is that building a global hydrogen infrastructure is more like building the railroad system in the 1800s. It is capital-intensive, physically demanding, and requires a level of patience that modern markets rarely possess. We are seeing a tug-of-war between the vision of a hydrogen-powered world and the brutal reality of a balance sheet that still shows significant quarterly losses. When we look at the recent stock movement, the context of today's 6% slide becomes even more interesting. Just a few days ago, on January 2nd, the stock surged over 13% following an upgrade from Clear Street. Analysts are starting to see a light at the end of the tunnel regarding the company's $200 million cost savings initiative. But every time the stock catches a bit of wind, the broader market pressures or sector-wide rotations seem to pull it back down. Today's movement is likely a combination of profit-taking from that recent 13% spike and a general wait-and-see approach ahead of the special shareholder meeting on January 29, 2026. This meeting is a massive catalyst because the company is asking for an increase in authorized shares from 1.5 billion to 3 billion. To the average investor, that sounds like a nightmare of future dilution. To the institutional desks at Fidelity Wealth Management or Schwab Intelligent Portfolios, it's seen as a necessary survival step to ensure the company doesn't run out of runway before its Georgia and Tennessee plants reach full scale. If you want to understand why this stock is so polarizing, you have to look at the trading volume. We are seeing tens of millions of shares trade hands daily. This isn't just retail speculation. There is a serious debate happening among institutional players about whether Plug Power can actually become the standard oil of hydrogen. The bears argue that the cost of producing green hydrogen is still too high compared to natural gas, while the bulls point to the rapidly falling costs of electrolyzers and the massive subsidies from the Inflation Reduction Act. The reality is likely somewhere in the middle. Plug Power isn't just a fuel cell company anymore. They are becoming a logistics and production powerhouse. They aren't just selling the engine, they are trying to own the gas station and the refinery too. Comment below how many shares of Plug Power you currently hold, or if you've moved your capital into more stable alternatives like Fidelity ETFs or the SoFi Robo-Advisor lately. Let's step back and look at what this company actually does to see if the business model supports the current valuation. Plug Power is at the center of the hydrogen economy, focusing on proton exchange membrane or PEM fuel cell technology, while competitors like Bloom Energy focus on solid oxide fuel cells for stationary power. Plug has built its empire on mobility. Their Gen Drive units are what power the forklifts in massive warehouses for companies like Home Depot and Walmart. This was their first major win, proving that hydrogen could beat lead-acid batteries in a 24/7 industrial environment because you can refuel a hydrogen forklift in 2 minutes, whereas a battery takes hours to charge. From there, they expanded into the entire ecosystem: Gen Fuel for the refueling stations, Gen Care for the service, and now the massive electrolyzer business, which is perhaps their most important growth engine for 2026. The business model has shifted from being a hardware provider to a vertically integrated energy company. They are building green hydrogen production plants across the United States. Their facility in Georgia is a prime example of the reality versus expectation tension. It took longer to get online than anyone expected, and it cost more than the original budget. But now that it's producing, it's proving that liquid green hydrogen can be produced at scale. This is critical because if Plug Power can produce its own fuel, its margins on the fuel delivery contracts should skyrocket. Right now, they often have to buy hydrogen on the open market at high prices to fulfill their contracts with their customers, which has been a major drain on their cash reserves. As more of their own production comes online throughout 2026, that fuel margin should theoretically flip from a loss to a profit. For the self-investing crowd or those using online investing sites, the complexity of Plug Power's financials can be a huge hurdle. Their revenue is growing, but their net losses have been staggering. In 2025, they were still dealing with the fallout of high interest rates and the massive capital expenditures required for their gigafactory in Rochester. This is why the Walmart deal announced this week is so significant. By cleaning up those warrants, they are making the stock more investable for the big institutions that manage Fidelity IRAs and individual brokerage accounts. Large funds generally hate the uncertainty of warrants hanging over a stock price. Removing that overhang is a signal that management is finally getting serious about shareholder structure and long-term stability. So, what is the outlook for the rest of 2026? The biggest risk on the horizon is the upcoming vote on January 29th. If shareholders reject the increase in authorized shares, the company might be forced into a reverse stock price to maintain its NASDAQ listing and attract more capital. This is the ultimate expectation versus reality moment. The market expects some form of dilution, but if the company can't secure the right to issue those shares, the liquidity crunch could become a reality very quickly. On the flip side, if the vote passes and the company provides a clear update at the Goldman Sachs Energy, Clean Tech, and Utilities Conference this week, we could see a massive short squeeze. Plug Power has historically been one of the most heavily shorted stocks on platforms like Robinhood and Interactive Brokers. When the narrative shifts from going bankrupt to surviving and scaling, those short positions have to cover, often leading to the parabolic runs we've seen in the past. When you're looking for investment help or navigating through various investing sites, it's easy to get lost in the noise of daily price swings. But if you look at the sector momentum, green hydrogen is becoming a national security priority for many countries. We are seeing massive installations in Africa and Europe, like the 5-megawatt project Plug just finished in Namibia. This global expansion is the reality that many domestic-focused investors are missing. Plug Power is positioning itself to be the technology provider for the entire planet's transition away from diesel. Whether they can do that profitably is the only question that matters. Their participation in the Goldman Sachs Energy, Clean Tech, and Utilities Conference this week is a huge opportunity for the leadership to convince big money that the 2026 roadmap is about execution, not just promises. In summary, the story of Plug Power today is one of a company at a major crossroads. The live price of $2.25 reflects the market's deep skepticism of their ability to scale without destroying shareholder value. The expectation is that more dilution is coming and that the path to a positive bottom line is still years away.
However, the reality is that the company is systematically checking off the boxes needed for a turnaround. They are settling dilution-heavy warrants with major partners, they are getting their domestic production plants up to capacity, and they are expanding their high-margin electrolyzer business globally. For an investor using a Fidelity brokerage or a SoFi trading platform, this is a classic high-risk, high-reward play. The central insight here is that Plug Power is no longer just a concept stock. They have real plants, real customers like Amazon, and a real chance to dominate the fuel of the future. The contrast between the current penny stock price and the multi-billion-dollar infrastructure they've built is the core tension of the trade. If they can navigate the January 29th shareholder meeting without a total collapse in investor confidence, the 2026 outlook might surprise everyone who has already written them off. As always,